Hello, everyone. Today, we're discussing a topic that has the global economy on edge, the US dollar. Recently, the dollar has not been performing well. While President Trump publicly declares that the dollar is performing exceptionally well, hard market data tells a different story. As the world's most pivotal reserve currency, individuals and central banks alike hold substantial dollar assets. Whether the dollar appreciates or depreciates directly impacts people's wallets and the stability of the global economy. Today, we'll break it down. What's really going on with the dollar? Why is there a discrepancy between official statements and market reality? What truths lie behind its sustained weakness that we must understand? And how does this affect ordinary Americans, global markets, and us ordinary people? We won't spread rumors or spin narratives. We'll rely solely on authoritative, publicly available data and facts to clarify this issue step by step. First, let's pose a central question. Have you ever wondered why the dollar, often called the global currency anchor, has fallen to its lowest point in 4 years? And why has nearly 10% of its value evaporated in just 1 year? Is this merely short-term market volatility or a sign that the global monetary landscape is shifting? We'll start with the most straightforward data, letting the facts speak for themselves. The US dollar is familiar to us all. It's the world's most actively traded currency and holds the largest share of global reserves. The core indicator measuring its strength is the dollar index, which represents the average exchange rate of the dollar against major currencies such as the euro, yen, and pound. A higher index indicates a stronger dollar, and vice versa. On Tuesday, the 27th of January 2026, the dollar suffered its steepest decline in months when the dollar index plummeted by 0.84% in a single day, closing at 96.219 before continuing its slide to 95.55. This marked its lowest level since mid-February 2022, essentially returning to 4-year lows. A 0.84% single-day plunge is an extreme anomaly. This reflects a significant shift in global market sentiment towards the dollar. Investors are losing confidence and selling dollar-denominated assets. Extending the time frame to consider full-year performance shows that throughout 2025, the dollar's value fell by 9.5%, marking its sharpest annual decline since 2017. If the purchasing power of your money were to diminish by nearly 10% in a single year, what would that mean? As the cornerstone of global trade settlements and foreign exchange reserves, such depreciation is far from normal market volatility. Major global reserve currencies such as the euro and yen usually experience relatively modest annual fluctuations. Minor swings usually stem from differing national economic growth rates and divergent monetary policies, aligning with market dynamics. However, the dollar's 9.5% decline in 2025, coupled with its single-day plunge on the 27th of January to a 4-year low and its fall below early 2022 levels, signals a broader pattern. The dollar's weakness is not a short-term correction, but rather a long-term downward trend that breaks with conventional market logic. More significantly, dollar depreciation has begun to impact global commodity pricing. Previously, we observed a clear pattern. A rising dollar meant falling commodities, while a falling dollar meant rising commodities. But this rule no longer holds. Since 2026, the US dollar index has declined, while Brent crude oil prices have fallen below $70 per barrel, and LME copper prices have surged past $13,387 per ton, reaching new highs. This shift reflects a fundamental change in the logic of global commodity pricing, moving from a dollar-dominated model to a multi-factor landscape driven by commodity-specific fundamentals plus national policies plus geopolitics. The weakening of the dollar's credit standing is one of the core drivers of this transformation. Why does dollar depreciation carry such significant influence? It is because the dollar's core value has never resided in the physical currency itself, but rather in its stability and credibility. Most global trade is settled in dollars, and central banks' foreign reserves are predominantly dollar-denominated assets. Multinational corporations' investments and ordinary individuals' overseas asset allocations also prioritize the dollar. The stability of the dollar is the bedrock upon which the global financial order functions. However, the dollar's sustained and significant depreciation is now leading directly to a critical outcome. The dollar-denominated reserve assets held by countries worldwide are shrinking. For instance, if a country holds $1 trillion in foreign exchange reserves and the dollar depreciates by 9.5% in a year, that country's wealth effectively shrinks by $95 billion overnight. This would represent a significant loss for any nation. For this reason, an increasing number of countries are reconsidering. Is the US dollar still worth holding in large quantities? Does its safe haven status still hold? In the past, people would instinctively buy US dollars and US Treasury bonds in times of geopolitical conflict or economic crisis, because they perceived the dollar as safe and reliable. But times have changed. With the dollar experiencing persistent depreciation and volatility, its safe haven function has weakened significantly. Global markets are now asking, can the dollar, as the global currency anchor, still fulfill this role? The dollar's depreciation has directly disrupted plans for global cross-border trade. Those in the import-export business know that, when signing contracts, they must predict exchange rate trends in advance and implement hedging strategies to avoid losses from fluctuations. However, with the dollar falling so rapidly and sharply, previous hedging tactics have become ineffective. Small and medium-sized foreign trade enterprises, which are already vulnerable to risks, have been hit particularly hard. Faced with such extreme exchange rate volatility, they do not know how to respond, and are reluctant to accept orders or collect payments, leaving them in a dire predicament. Even U.S. domestic enterprises cannot escape the impact. Data from November 2025 shows that the price of U.S. exports increased by 3.3% year-on-year, which is significantly higher than the 0.9% increase recorded in November 2024. Prices for agricultural exports climbed to 0.6%, while non-agricultural exports rose 3.3%. Prices for export commodities such as capital goods, automobiles, and consumer goods are all rising. On the surface, this appears positive. A weaker dollar makes U.S. goods cheaper and more competitive internationally. However, import costs are also rising. As a major consumer nation, the U.S. relies heavily on imports, from energy and food to everyday clothing and electronics. With the dollar's depreciation, these goods now cost more. Ultimately, rising import costs will be passed on to American consumers in the form of higher prices. For example, the price of goods imported from Japan increased by 2.6% year-on-year, the highest increase since October 2011, and consumers will ultimately bear these costs. Therefore, the dollar's depreciation is not just a market fluctuation. It is a clear warning signal. It tells us that the strong position the dollar has long enjoyed, built upon the strength of the U.S. economy and the advantages of its financial system, is showing cracks that may be difficult to reverse. The dollar's weakness is the result of multiple deep-seated problems that have accumulated over time and are not the result of a single incident. The global market reaction is now evident. Major institutional investors and central banks worldwide are quietly adjusting their asset allocations, reducing their holdings of dollar-denominated assets in favor of gold, euros, renminbi, and other currencies. The rise in gold prices of over 12% throughout 2025 is the clearest evidence of this. Investors are selling dollars to buy safer haven assets, creating a vicious cycle of downward pressure on the dollar. At this point, some may ask, why has the dollar reached this juncture? How can the world's largest economy see its currency persistently weaken? In reality, the dollar's depreciation stems not from a single cause, but from the combined impact of three core factors: policy uncertainty, political noise, and a crisis of confidence in the Federal Reserve. Let's break these down in plain language, one by one. Firstly, the Trump administration's aggressive tariff policy has created significant policy uncertainty. Shortly after returning to the White House in January 2025, Trump rolled out the so-called reciprocal tariff policy, which officially took effect on the 2nd of April. Put simply, this policy imposes high tariffs on multiple global trading partners, 20 to 24% on the EU and Japan. And a minimum baseline tariff of 10% was also established. Tariffs fundamentally increase the cost of imported goods. Trump aimed to protect domestic U.S. businesses through this approach, while also pressuring other nations to make concessions and reduce America's trade deficit. However, financial markets fundamentally dislike uncertainty. When investors cannot predict policy shifts or identify risks, they hesitate to invest or hold related assets. Not only did Trump's tariff policy elevate overall global trade costs, it also triggered a chain reaction. Major trading partners such as the EU and China retaliated with counter-tariffs, igniting a large-scale trade conflict. As trade friction escalated, global industrial and supply chains were disrupted, which dragged down worldwide economic growth. As the world's largest economy, the U.S. inevitably felt the impact, with weakening economic fundamentals causing the dollar to lose its footing. Adding to the problems, Trump's tariff policy proved erratic, further amplifying uncertainty. Just as high tariffs were implemented in April, they were reduced to 30% on China following negotiations in May. Then, in August, the U.S. abruptly suspended some tariffs. This policy of changing direction overnight left global capital utterly bewildered, making investors hesitant to allocate assets in dollars. No one could predict whether tariffs would change again the next day, which could potentially damage their holdings. Consequently, capital continues to flow out of the U.S., reducing demand for the dollar and driving down its exchange rate. Furthermore, the negative impact of tariff policies extends beyond traditional trade sectors. For example, U.S. export controls on semiconductors, which were intended to curb certain nations' advancements in artificial intelligence, have backfired. U.S. infrastructure relies on a critical electrical component, transformers. Yet domestic production capacity meets only 1/5 of domestic demand, with the remainder being heavily dependent on imports. Around 60% of global transformer production originates in China. By 2025, China's transformer exports had surpassed 60 billion yuan, marking a year-on-year increase of over 30%. In 2024 alone, the U.S. spent around $4 billion importing transformers from China. Despite U.S. tariffs being imposed on Chinese products, finding alternatives remains challenging. Transformers from other countries are either too expensive or do not meet quality standards. This policy-induced imbalance in the supply chain adds another layer of uncertainty to the U.S. economy, naturally dampening market confidence in the dollar. A second core factor is domestic political uncertainty in the U.S., particularly the risk of government shutdowns, which continues to erode the nation's creditworthiness. In January 2026, Karl Sharmota, chief market strategist at Cambridge Global Payments, explicitly stated that the U.S. government may once again face a shutdown, significantly heightening uncertainty over economic policies. What is a government shutdown? Put simply, it occurs when the U.S. Congress and the administration fail to agree on budget appropriations. Lawmakers, locked in partisan disputes, prevent the passage of the government budget. Without funding, the government is forced to partially shut down, halting public services. From the 1st of October to the 12th of November 2025, the U.S. federal government experienced such a shutdown. This resulted in the October Core Import-Export Index data being withheld due to data gaps, and the release of the December import-export price data being delayed until the 10th of February 2026, when a nation's core economic data can be released or delayed at will. How can global investors accurately gauge the true state of its economy? Markets inevitably descend into chaos and volatility naturally intensifies. Furthermore, government shutdowns are not just short-term disruptions. They expose systemic failures in the U.S. political machinery. How strong can the credibility of a country's currency truly be if it cannot manage its own budget or guarantee basic public services? Political stability is a crucial safeguard for investors' assets. Relentless partisan bickering and the persistent risk of government shutdowns signal to global markets that America's internal governance is deeply flawed. Currency credibility fundamentally reflects national credibility. So when the political landscape is chaotic, the dollar's credibility inevitably weakens and investors become reluctant to hold it. The third and most critical factor is the crisis of confidence in the Federal Reserve. The uncertainty surrounding the selection of its next chair and questions about its independence directly undermine the dollar's monetary foundation. The Federal Reserve is the central bank of the United States and is responsible for formulating monetary policy to maintain price stability and full employment. For global markets, the Fed's independence is paramount, meaning that its policy decisions should be based solely on economic data and be free from political interference. This ensures the professionalism and stability of monetary policy, thereby fostering trust in the dollar. For a long time, the Fed upheld these principles. Regardless of which party held power, the Fed made independent decisions, serving as a crucial pillar supporting the dollar's long-term strength. However, the situation has now changed. Current Fed Chair Jerome Powell's term ends in February 2026. And as of the 29th of January, no successor has been named. Markets are even more concerned that the Fed's independence may be compromised, turning it into a tool that serves political objectives. Trump has consistently advocated interest rate cuts in order to stimulate economic growth through loose monetary policy. However, the Fed's primary objective is to control inflation, which creates an inherent conflict between these two priorities. If the Fed were to force interest rate cuts to align with Trump's political agenda and disregard inflationary pressures, it would completely undermine its professionalism and credibility. Global investors primarily hold dollar-denominated assets because they trust the Fed's decision-making process and the stability of U.S. monetary policy. If the Fed were perceived as no longer independent, with monetary policy swayed by politics, who would dare to hold dollars? Capital would inevitably flee, putting pressure on the dollar's exchange rate. The dollar is under pressure from three converging factors: policy uncertainty, political noise, and the Fed's credibility crisis. Market confidence in the greenback has steadily eroded, ultimately manifesting as the dollar index's sustained decline to a 4-year low. The dollar's status as the global reserve currency is now under unprecedented pressure. There is a fascinating contrast here. While market data clearly shows the dollar depreciating and confidence eroding, President Trump repeatedly claims that the dollar is performing exceptionally well and even states that dollar depreciation is a good thing. What is going on here? Why does Trump hold this view? On the 27th of January 2026, the day the dollar index plunged 0.84% to a 4-year low, Trump explicitly told the media that he did not believe the dollar's decline was excessive. and insisted that its current performance was strong. His remarks were met with further declines in the dollar index. The market clearly didn't agree with him. In truth, Trump's logic is straightforward. He views the dollar's exchange rate as a tool to improve U.S. trade. From his perspective, a weaker dollar makes American exports cheaper and more competitive in international markets, thereby boosting exports and reducing the trade deficit. This has been a core tenet of his administration since his first presidential term, when he expressed strong dissatisfaction with other nations devaluing their currencies to gain trade advantages. Trump has repeatedly recalled how, during past trade negotiations with Japan and South Korea, both nations deliberately devalued their currencies, the yen and the won, to make their goods cheaper and capture the U.S. market. He claims to have fiercely argued with these countries, calling such practices unfair and arguing that they make it difficult for American businesses to compete. However, Japan and South Korea countered by blaming the strong dollar, implying that their actions were not intentional devaluation, but rather a consequence of the dollar's strength. Therefore, from Trump's perspective, if other countries could gain advantages through currency devaluation in the past, the U.S. could now enhance its trade competitiveness by allowing the dollar to depreciate moderately. Moreover, certain data supports his view. In Q3 2025, U.S. exports grew by 9.6% year-on-year. By November 2025, U.S. export prices had surged by 3.3% year-on-year, with prices to Canada rising by 5.4%, to Mexico by 5.0%, and to Japan by 6.2%. These figures likely form the basis of Trump's assertion that the dollar is performing exceptionally well. However, it's important to note that export growth driven by devaluation is not sustainable. Firstly, it provokes retaliatory measures from trading partners. As previously mentioned, both the EU and China have imposed countervailing tariffs on U.S. goods, which will ultimately lead to a contraction in global trade that will impact U.S. exports too. Secondly, while exports grow, import costs also rise. American consumers face rising prices, and corporate profits are squeezed, especially for manufacturing firms that rely on imported raw materials and will therefore struggle. Furthermore, Trump's view of the dollar diverges sharply from that of global markets. Global markets treat the dollar as the global currency anchor, valuing its creditworthiness, stability, and long-term worth. However, Trump sees it solely as a trade tool, fixated on its short-term stimulus effect on exports. One perspective is long-term and holistic, while the other is short-term and narrow. This explains the stark disconnect between official rhetoric and market realities. Moreover, Trump's double-standard approach has raised global doubts about America's credibility. You previously criticized others for devaluing their currencies, calling it unfair trade. Yet now you are actively devaluing the dollar yourself and claiming it is beneficial. Isn't this contradictory? Such actions further erode America's influence within the global monetary and trade systems, indirectly damaging the dollar's credibility. Even though Trump repeatedly emphasizes that the dollar is performing well, the market remains unconvinced. Global investors base their decisions on tangible data and risk assessments, not individual statements. As long as the dollar continues to depreciate and confidence crises persist, capital outflows will continue, making it difficult for the dollar to strengthen. Of all the underlying factors driving the dollar's sustained depreciation, one issue stands out as both the most fundamental and the most critical: the sheer scale of U.S. debt. While policy uncertainty and political noise may be considered surface-level issues, the debt problem is the root cause, the core reason why global markets question the dollar's long-term value. Do you know how much debt the U.S. currently has? As of the 28th of January 2026, its total liabilities had reached $38.5 trillion. For those unfamiliar with this figure, consider this comparison. In 2023, the US GDP totaled $27.29 trillion. This means America's debt now exceeds 140% of its annual economic output. Furthermore, according to the U.S. government's budget projections, federal debt is expected to increase to $39.04 trillion by the end of the 2026 fiscal year. Combined with state and local government debt, the total debt will reach $42.8 trillion and continue to grow. What does such colossal debt signify? It means the U.S. government must make enormous annual interest payments. In 2025, interest payments to the U.S. federal government already exceeded $1 trillion, accounting for over 15% of its fiscal revenue. Consider this: a nation dedicating over a fifth of its annual earnings to interest payments. What does that signify? It's similar to a household spending most of its monthly income on mortgage and car loan interest, leaving little for everyday expenses or savings. Can such a lifestyle endure? Trump has consistently advocated interest rate cuts in the hope of stimulating the economy by lowering financing costs. However, this approach fails to address the root of the problem. While short-term rate cuts might slightly reduce the government's debt servicing costs, long-term market concerns about America's solvency will only intensify. How can a nation that is perpetually borrowing and cutting rates ever hope to repay such colossal debts? Consequently, long-term borrowing costs remain stubbornly high. Consider the 10-year U.S. Treasury yield, which consistently hovers above 4%. This reflects the market's risk premium on U.S. debt. Holding U.S. bonds requires higher interest payments because the risk is simply too great. In the eyes of global investors and central banks, America's endless borrowing and spending approach is seen as reckless extravagance. A nation's currency cannot sustain long-term strength if its fiscal balance remains perpetually imbalanced and its debt continues to increase. The dollar's depreciation is essentially the market voting with its feet. Investors lack confidence in America's long-term debt repayment capacity, which is prompting the widespread divestment of dollar-denominated assets. America's fiscal issues extend far beyond sheer debt magnitude. The core problem lies in its persistent budget deficits. Put simply, the U.S. government spends far more than it earns each year, and this gap is continually widening. By 2025, the federal budget deficit is projected to exceed $1.8 trillion, a staggering figure equivalent to the annual GDP of many nations. Trump sought to offset the deficit with tariff revenues, but this approach is fundamentally flawed. The U.S. tax code includes a deduction rule whereby tariffs paid by corporations can be offset against their income tax liability. This means that, after paying tariffs, companies pay less income tax to the IRS. While tariff revenue may appear to increase, income tax revenue decreases, ultimately having a negligible effect on reducing the deficit. It is essentially a smoke screen that does nothing to address the fundamental problem of fiscal imbalance. The persistently widening deficit and ever-rising debt have finally triggered the vigilance of international rating agencies. In October 2025, Scope Ratings, a European credit rating agency headquartered in Berlin, Germany, formally downgraded the U.S. sovereign credit rating from IA to A due to structural issues, including the ongoing deterioration of U.S. public finances and the decline in government governance standards. This is no minor matter. Sovereign credit ratings are authoritative assessments by professional global institutions of a nation's debt repayment capacity and creditworthiness. A downgrade signifies heightened credit risk for the United States. Going forward, the U.S. will face higher borrowing costs when seeking loans. while global investors holding U.S. Treasury bonds and dollar-denominated assets will be subject to greater risk. This will further suppress the dollar's exchange rate, creating a vicious cycle. Even more troubling is the fact that Trump has advocated interest rate cuts, which could exacerbate inflationary pressures. While rate cuts typically stimulate the economy, in the context of high debt and fiscal imbalance, they would only provide short-term market relief. In the long term, this would erode the currency's purchasing power, heighten fears of dollar depreciation, and fuel growing inflationary pressures. America's debt problem has become a deeply entrenched structural issue that successive administrations have failed to resolve. Rather than tightening fiscal policy and controlling debt, the Trump administration has exacerbated the issue through aggressive tariff policies and expansionary spending. Global markets clearly recognize that the unchecked expansion of U.S. debt and the growing uncertainty surrounding its repayment capacity are the root causes of the dollar's confidence crisis. Furthermore, the tariff war has intensified the negative debt-dollar cycle. It has led to a significant reduction in U.S. imports. Following the implementation of the tariff policy in April 2025, the year-on-year decline in U.S. import value exceeded 15%. It is important to recognize that U.S. imports are the main channel through which global dollar liquidity is distributed. Other nations earn dollars by exporting goods to the U.S., which they then invest in U.S. stock and bond markets or hold as foreign exchange reserves. This process recirculates dollars back to the U.S., thereby underpinning its capital markets and monetary credibility. However, with imports now sharply contracted, other countries are earning far fewer dollars, drastically reducing the scale of dollar repatriation to the U.S. Countries that rely heavily on trade with the U.S. now face dollar shortages, forcing them to sell dollar-denominated assets to obtain local currency for domestic expenditure. This further intensifies the downward pressure on the dollar and disrupts its global circulation system. Thus, the weakening of the dollar is driven by three underlying factors: massive debt, irreparable fiscal deficits, and downgraded credit ratings. This issue cannot be resolved through short-term policy adjustments. It is long-term and structural, representing the fundamental reason for the loss of confidence in the dollar in global markets. At this point, some may ask, is a depreciating dollar entirely negative? Could it potentially bring some benefits? Objectively speaking, dollar depreciation has dual implications and cannot be generalized, as it has both positive and negative effects. However, it should be noted that these positive impacts mostly benefit a select few, while the negative consequences are borne by ordinary Americans and even global markets. First, let's examine the positive aspects. For U.S. exporters, a weaker dollar is advantageous. When the dollar depreciates, American goods become cheaper when converted into foreign currencies, making them more competitive. This is particularly evident in labor-intensive sectors such as agricultural products and light industrial goods, where export growth has accelerated significantly. In Q3 of 2025, U.S. exports grew by 9.6% year-on-year, with export prices rising by 3.3% in November. Prices for agricultural exports increased by 2.6% annually, primarily due to higher prices for vegetables, nuts, and fruits. Non-agricultural export prices also climbed by 3.3%, with prices for both capital and consumer goods rising. However, only crude oil export prices declined, slightly dampening the overall growth rate. Secondly, the depreciation of the dollar also benefits U.S. multinational corporations. Profits earned overseas by these firms are typically denominated in local currencies. When these profits are repatriated to the U.S., the weaker dollar allows them to be exchanged for more U.S. dollars, effectively generating additional foreign exchange gains. This boosts corporate profits and incentivizes overseas investment and expansion. Additionally, a weaker dollar offers breathing room to countries globally burdened with substantial dollar-denominated debt. Since most of their foreign debt is priced in dollars, a depreciating currency reduces the amount of local currency needed to repay these debts, thereby easing debt pressures and alleviating some of the debt crises facing emerging markets. Furthermore, a weaker dollar can increase U.S. exports. As export industries expand, more jobs are created, which could increase U.S. employment rates. At the same time, a cheaper dollar lowers the cost for foreign tourists visiting the U.S., attracting more visitors and stimulating growth in U.S. service industries such as tourism, dining, and lodging. Another positive impact. U.S. export performance is particularly robust within the North American Free Trade Agreement (NAFTA) region. Export prices to Canada and Mexico have surged significantly, indicating enhanced U.S. competitiveness in regional trade and stable intraregional demand. However, these positive effects are concentrated among specific groups, such as export-oriented enterprises, large multinational corporations, and indebted nations. Meanwhile, the negative impacts of dollar depreciation have a much broader reach and will be felt most directly by ordinary Americans. The most immediate impacts are rising import costs, inflation, and increased living expenses. As a major consumer nation, the U.S. relies heavily on imports for everything from energy and food to everyday clothing, electronics, and household goods. A weaker dollar means spending more dollars to purchase these items. When import costs rise, businesses pass these costs on to consumers, leading to higher prices for end products. The most obvious example is fuel prices. Energy products such as oil and natural gas are priced in dollars. A weaker dollar, combined with higher import costs, drives up the price of gasoline and natural gas in the U.S. Energy is fundamental to industrial production and daily life. When fuel prices rise, prices across the entire industrial chain follow suit, amplifying inflationary pressures. Although U.S. energy import prices fell in November 2025 due to short-term factors, cost pressures stemming from dollar depreciation have accumulated over the long term. Consequently, Americans' fuel and heating expenses will only continue to rise. Beyond fuel, the cost of imported goods such as automobiles, electronic components, and foodstuffs is also rising. For example, the price of U.S. imports of Japanese automobiles and electronic parts has increased significantly year on year, pushing up the cost of vehicles and electronics domestically. Rising food import costs disproportionately impact low-income groups, whose already challenging livelihoods become even more difficult as prices climb. While the U.S. core PCE price index hadn't skyrocketed by 2025, it consistently exceeded the Federal Reserve's 2% inflation target. Moreover, the inflationary impact of rising import prices was gradually becoming apparent. Put simply, the value of Americans' money was decreasing. They had to spend more to buy the same goods, and the cost of living was steadily increasing. Consider this. The benefits of dollar depreciation largely accrue to exporters and large multinational corporations, while the burden of rising prices and increased living costs is borne by all American citizens. This imbalance in benefit distribution significantly diminishes the positive impact of dollar depreciation. The core issue lies in the fundamental nature of dollar depreciation, which reflects a loss of global confidence in the currency. The dollar represents more than just paper. It symbolizes America's national stability, global credibility, and international leadership. The 9.5% decline in the U.S. dollar index in 2025 was its steepest annual drop in almost 10 years. This figure reflects global market anxiety over unreliable U.S. policy and fiscal imbalances. Even if there are short-term gains in exports and employment, these cannot compensate for the loss of national credibility and global influence. This deep-seated crisis is far more alarming than temporary economic fluctuations. Global markets do not judge based on words alone, they judge based on actions. The dollar's depreciation is a vote of no confidence in U.S. policy, debt, and creditworthiness. Nations and investors worldwide are quietly asking, can the dollar remain the global currency anchor? Or has holding dollars become a high-risk investment? These questions lie at the heart of the dollar's decline. It should now be clear that the dollar's sustained weakness is not a passive market fluctuation. It stems from the Trump administration's deliberate policy of pushing for depreciation, compounded by the tariff war which is disrupting the dollar's global circulation, and by multiple nations offloading dollar assets. These forces have converged to drive the decline. Moreover, the dollar is likely to remain weak in the medium to short term as long as the tariff war policy remains unchanged, and its status as the global currency anchor will continue to be scrutinized. In an interview, Ed Hertz, an energy researcher and economics lecturer at the University of Houston, explicitly stated, "The various factors suppressing the dollar are fundamentally the result of the Trump administration's deliberate policy to devalue it. In practice, the U.S. government has gone to great lengths to depreciate the dollar, even refusing to repay some debts incurred due to the tariff war. This approach undermines the dollar's creditworthiness. If debts can go unpaid, who would dare hold dollars?" As previously mentioned, the tariff war has caused a sharp contraction in U.S. imports. After April 2025, import values saw year-on-year declines of over 15%, which has directly disrupted the global circulation of the dollar. Other nations unable to earn sufficient dollars have been forced to sell dollar-denominated assets to obtain local currency for domestic expenditure. This has further intensified the downward pressure on the dollar. The global circulation of the dollar was originally a self-reinforcing process. Countries earned dollars through exporting to the U.S., which they then invested in U.S. stock and bond markets. This supported the stability of U.S. capital markets and bolstered the dollar's strength. This, in turn, attracted more countries to hold dollars, creating a virtuous cycle. However, the tariff war has disrupted this cycle. Reduced dollar repatriation and increased global selling have impacted U.S. stock and bond markets. The recent downgrade of the U.S. debt rating by international rating agencies is a direct consequence of this disruption. Ed Hertz further emphasized that Trump's unpredictable governing style is the archenemy of financial markets. Above all else, financial markets detest uncertainty, and the Trump administration's various external threats, such as geopolitical tensions with Venezuela and Iran, have significantly amplified global market uncertainty. Global investors are not only selling off the dollar, but ordinary Americans are also increasingly divesting from it and turning to safe haven assets like gold. The rise in gold prices of over 12% throughout 2025 is the most direct proof that everyone is fleeing the dollar in search of safer assets. In such an uncertain market environment, even modest capital outflows from the dollar can depress the dollar exchange rate through market leverage and create a sustained weakening trend. Furthermore, the pricing logic for global commodities is shifting due to the dollar's weakening credibility. The dollar's previous dominance is being disrupted, and a de-dollarization trend is gradually emerging. An increasing number of countries are experimenting with using their local currencies for trade settlements, moving away from complete reliance on the dollar. For example, some nations are now settling oil trade in renminbi or euros, and emerging market nations are adjusting their foreign exchange reserve structures to reduce their holdings of U.S. dollars. This has significantly diminished the correlation between commodity prices and the dollar, gradually eroding its global influence. In the short to medium term, we have seen cases of bond cops selling off U.S. treasuries, where global investors massively divest from U.S. debt, forcing the U.S. government to adjust its fiscal policies. Such scenarios have previously attracted intense scrutiny from the White House. While it is uncertain whether this will happen again this year, it is certain that the global sell-off of dollar-denominated assets will continue. According to the latest IMF data, the dollar's share of global central bank foreign exchange reserves has declined for several consecutive years. By the fourth quarter of 2025, this figure had fallen further, dropping below 58% and reaching its lowest level in nearly 3 decades. This clearly reflects the ongoing decline in global market confidence in the dollar. An increasing number of countries are diversifying their holdings by increasing their reserves of gold, euros, renminbi, and other assets, in order to hedge against the risk of dollar depreciation. Therefore, as long as the Trump administration's tariff war policies persist and policy uncertainty, impaired global dollar circulation and the sell-off of dollar assets continue, downward pressure on the dollar will remain. In the medium to short term, it will be difficult for the dollar to reverse its weak trend. The dollar's status as the global reserve currency does not come naturally. It relies on a stable policy environment, smooth global circulation, and reliable national credit. All three of these foundations have now been shaken, and global market skepticism towards the dollar will only grow. The dollar index fell by 9.5% in 2025, hitting a 4-year low in January 2026. These facts clearly demonstrate that the era of dollar dominance is over. No matter how often President Trump proclaims that the dollar is performing exceptionally well, this cannot alter the actual trajectory of the market. The tariff war and dollar depreciation have formed a vicious cycle. The tariff war escalates trade friction, weakening economic fundamentals and triggering capital outflows and devaluation of the dollar. The depreciation of the dollar further erodes its credibility, intensifying capital outflows, and potentially forcing the U.S. to adopt more aggressive tariff policies in an attempt to reduce the trade deficit, thereby only worsening the cycle. Unless this cycle is broken, it will be difficult to improve the dollar's situation. Finally, let's summarize and discuss future trends. Transformations in the global monetary system never happen overnight. The weakening of the dollar will be a protracted process and will not be instantly replaced by other currencies. However, current signals are unmistakable. The trend towards a multipolar global monetary landscape is accelerating. The dollar's credibility crisis is not just a result of concentrated U.S. fiscal and policy issues, but an inevitable consequence of global economic realignment and intensifying geopolitical competition. Over the past few decades, the United States has used its considerable economic strength and sophisticated financial system to secure the dollar's position as the world's main reserve currency. This hegemonic status granted America dominant influence in the global economy. However, this advantage is now eroding due to a loss of global market trust caused by U.S. policy credibility issues, mounting debt, and internal governance chaos. Restoring the dollar's credibility and preserving its status as the global reserve currency requires more than mere rhetoric about the dollar's strong performance. Instead, concrete action is required, such as confronting debt risks, curbing disorderly fiscal expansion, halting aggressive tariff policies, safeguarding the independence of the Federal Reserve, and rebuilding global market trust. Failure to do so will only accelerate the dollar's global decline, diminishing America's influence within the world economic system. For global markets, the dollar's weakening and eroding credibility present both challenges and opportunities. In the short term, dollar depreciation could trigger exchange rate volatility, disrupt trade, and destabilize asset prices. Nations heavily reliant on dollar-denominated settlements and reserves face significant risks. However, there are also opportunities. A weaker dollar could create space for a more diverse range of currencies and trade settlement methods. Nations can increasingly reduce their excessive dependence on the dollar by adopting diversified asset allocation and trade settlement methods, thereby lowering their own risks and enhancing their autonomy within the global economy. While the direct impact of dollar depreciation may not be immediately apparent to ordinary individuals, the indirect effects remain significant. For example, fluctuations in global commodity prices could affect the domestic prices of certain goods, while the costs of overseas investments, study abroad programs, and travel could also change. This serves as a reminder that, when making decisions about asset allocation and consumption, we must pay closer attention to global economic dynamics, particularly the trajectory of the dollar, and shifts in the global monetary landscape, to mitigate risks more effectively and make more informed choices. Can the dollar regain the trust of global markets in the future? How will the global monetary landscape be restructured? Will a new currency emerge to replace the dollar's dominant position? These questions remain unanswered. However, it is certain that the era of dollar hegemony has passed, and that the global monetary system is entering a new phase of transformation. This process may be fraught with volatility and uncertainty, but it will ultimately lead to a system that is fairer, more stable, and more diverse. After all, stable global economic development requires a trustworthy and stable monetary system, rather than a landscape dominated by a single currency rife with risks and uncertainties. The dollar's depreciation and the ensuing credit crisis could well mark a pivotal starting point for this transformation. What we can do is maintain a rational perspective, discern the underlying trends, and calmly navigate whatever changes emerge. Today, we have taken the time to clearly explain the truth behind the dollar's depreciation, its influencing factors, and its positive and negative impacts and future trends. The core message is this: the weakening of the dollar is the result of multiple overlapping issues, policy, politics, debt, and more, and fundamentally represents a loss of credit. The future trend will be the emergence of a multipolar global monetary system. We hope today's content has helped you to gain a clearer understanding of this issue. All right, that's all for today. See you next time.